Senior precious metals analyst Bill Holter just issued a warning that should terrify anyone holding paper silver. He says the commodity exchange, Comex in New York, may experience a physical silver delivery default as early as March 2026. Not next year, not eventually. March, that's 4 weeks from now. And the number that's causing the panic? 80 million ounces. That's the amount of delivery demand Holter expects to hit Comex when March contracts come due. And here's the problem. Comex only has 110 to 120 million ounces in registered inventory. Registered means deliverable, metal that can actually be handed over to fulfill a contract. If 80 million ounces stand for delivery in March, that wipes out 70% of available inventory in 1 month. But it gets worse, because what happened in January, a month that's not supposed to be a delivery month, tells you everything you need to know about what's coming. In January 2026, Comex received delivery requests for over 40 million ounces of silver. In a normal January, 1 to 2 million, maybe. 40 million is 20 to 40 times higher than normal in a non-delivery month. So if January, which nobody expects deliveries in, saw 40 million ounces, what happens in March when it's a primary delivery month? Holter's estimate, 70 to 80 million ounces. And if that happens, Comex doesn't have enough metal. Let me say that again because this is the entire thesis. If 70 to 80 million ounces stand for delivery in March, and Comex only has 110 to 120 million in registered inventory, they will be forced to deliver almost everything they have. And here's the question nobody at Comex wants to answer. Is any of that inventory encumbered? Is it double pledged? Is it already spoken for? We don't know. And that's the problem. Because if even a small portion of that registered inventory is not actually available, Comex can't deliver. And if they can't deliver, contracts become worthless. Not devalued, worthless, zero. A failure to deliver completely destroys the credibility of Comex pricing. It destroys the entire paper market structure, and it triggers a chain reaction that spreads to gold, to credit markets, and potentially to the entire financial system. Those aren't my words, those are Holter's. He said, and I'm quoting directly, if a delivery failure occurs in March 2026, it will trigger currency devaluation and the collapse of the entire financial system. The real economy relies on credit to function. Everything you touch, everything you do involves the participation of credit. If credit becomes inaccessible, the real economy will come to a complete halt. Now, before you dismiss this as doomsaying, let me show you why the data supports exactly what he's warning about. Drop a comment right now. Tell me where you're watching from. And tell me honestly, do you think Comex can actually deliver 80 million ounces in March, or is this the moment the system breaks? I want to know what you think. Subscribe to GoFinance if you haven't already, because what I'm about to show you won't be on CNBC. Here's what's already happening on the ground. And these are not opinions. These are documented facts. January 7th, 2026, 1,624. January contracts that weren't supposed to go to delivery, stood for physical delivery. That's 8.1 million ounces in one day. And 99% of those delivery warrants were issued by JP Morgan, one bank, delivering almost all of it to numerous different stoppers. That's not normal market behavior. That's a coordinated move. And the open interest, instead of declining after deliveries like it's supposed to, it increased by 1,431 contracts, meaning more people are entering the market demanding immediate physical delivery. Not hedging, not speculating, demanding metal. And it's not just January. February open interest increased by 1,564 contracts in a single day. Buyers are stepping into Comex and using it as a physical delivery market. Not a hedging market, not a price discovery market, a physical acquisition market. And that changes everything. Because Comex was never designed to handle this level of delivery demand, it's a paper market. 99% of contracts are supposed to settle in cash. Only 1% is supposed to go to actual delivery. But when 5% want delivery, 10%, 20%, the system can't handle it, and we're already seeing the cracks. Let me show you the inventory data. Because this is where the math becomes undeniable. Comex registered silver inventory has collapsed 70% since 2020, from 346 million ounces down to around 110 million. The London Bullion Market Association, LBMA, down 40%. Shanghai at decade lows. The vaults are draining on 3 continents simultaneously, and in just 7 days in mid-January, 33.45 million ounces were physically withdrawn from Comex for delivery. That's 26% of registered inventory. Gone. In 1 week. Think about that. 1 week. 1/4 of deliverable inventory vanished. And the data shows that a significant portion of what's reported as registered is either non-eligible or already encumbered, meaning it's not truly available for delivery. The pool of actually deliverable, fully eligible silver is much smaller than the headline figures suggest. So when Holter says 110 to 120 million registered, the real number might be 70 million, 50 million. We don't know, and that's terrifying. Because if 80 million ounces stand for delivery and only 50 million are actually available, Comex defaults. Now here's where JP Morgan comes in. And this part of the story is absolutely critical. JP Morgan now controls approximately 40% of Comex silver futures contracts, and their warehouse holds close to 50% of all deliverable silver bullion on Comex. Let me repeat that. One bank, 40% of futures contracts, 50% of deliverable inventory, and their behavior just changed dramatically. For years, JP Morgan was the largest short in silver. They were betting the price would go down. They were suppressing it. They paid a $920 million fine in 2020 for manipulating precious metals futures markets. But in 2025, they flipped from massive short to net long, from suppressing the price to standing for maximum physical delivery. The first delivery report of 2026 shows JP Morgan aggressively taking delivery, not rolling contracts, not selling in cash, taking physical metal into their warehouse. That's a complete strategic reversal. And the question you have to ask is why? Why would the bank that spent decades shorting silver suddenly reverse and start hoarding it? There are only two possible answers. Either they know something the market doesn't, or they're trying to corner the market. And based on the data, it might be both. Because here's what else is happening. JP Morgan recently relocated their gold trading desk from New York to Singapore. Outside U.S. regulatory oversight. They're positioning for something. And whatever it is, it involves accumulating as much physical metal as possible before March. About 75% of you watching aren't subscribed. If this analysis is connecting dots you've never seen before, hit subscribe. Drop a comment and tell us, do you think JP Morgan knows Comex is about to default? Now let me show you what China just did to make this exponentially worse. On January 1st, 2026, China implemented the most aggressive precious metals export controls since rare earth restrictions. New licensing requirements for refined silver. Only 44 companies in the entire country qualified for export licenses. Hundreds of smaller refiners that have been supplying the global market for decades, blocked. China controls 60 to 70% of the world's refined silver supply, and they just choked it. Their state media described this policy as upgrading silver from a common commodity to a strategic resource. That's the exact same language China used before they restricted rare earth exports. Same playbook, different metal. And the impact was immediate. Shanghai silver prices started trading at $6 to $13 premiums over Comex. In some cases, $8 to $15 above Western spot. On January 1st, while Comex silver futures showed $72 per ounce, physical bullion dealers in Japan and UAE were selling, when they could find inventory, at $130 per ounce. That's an 80% premium. 80% for the same metal. That's not arbitrage, that's bifurcation. The paper market and the physical market are now two completely different assets. And when you try to exploit that spread, buy silver on Comex, ship it to Shanghai, sell at the premium, you discover something uncomfortable. There isn't enough metal to move. The arbitrage should close the spread, but it's not closing. Because when traders try to pull physical metal out of Comex to ship east, they're finding out the metal isn't there. This is a classic bank run. Except instead of depositors lining up outside a bank, it's Samsung and solar manufacturers lining up at Comex saying, we need physical metal, and we need it now. And Comex can't deliver. Which brings us to lease rates, because this is another signal that the system is breaking. Silver lease rates measure the cost to borrow physical metal for short-term delivery. Historically, they fluctuate between 1% and 3%. In October 2024, they hit 11%. During periods of acute tightness in 2025, they reached 200% annualized. 200%. That means someone was willing to pay double the value of the silver just to borrow it for a year. Why? Because they couldn't find it any other way. And when lease rates spike like that, it means the interbank silver lending market has frozen. Banks and institutions that normally lend silver to each other for trading and hedging purposes have stopped. Each institution is hoarding what they have for their own survival. And when the lending market freezes, liquidity disappears. And when liquidity disappears, prices become unstable. Small trades can move the market violently. That's exactly what we're seeing. Silver went from $31 in January 2025 to an all-time high of $120 in January 2026, almost 4 times. Then it crashed 27% in a single day. The worst session since the Hunt brothers in 1980, and within 4 days, it bounced back to 90. That's not normal price action. That's a market under extreme stress. And the stress is only getting worse because industrial buyers are panicking. In late January 2026, Samsung finalized a $7 million mining prepayment deal with Silverstorm Mining to restart the La Parida silver mine in Mexico. But there's one clause in the contract that made procurement managers across the industry gasp. Samsung obtains the exclusive right to purchase 100% of the mine's silver output for the next 2 years. This is not market-based procurement. This is resource lockup. Samsung didn't go to Comex to buy paper silver. They didn't chase prices higher in the spot market. They paid cash to restart a mine and used a contract to lock in 2 full years of production for themselves. That means the silver from this mine, every single ounce, is no longer available to the open market. It's earmarked. It's gone. And Samsung isn't alone. Tesla, Google, Boeing, General Motors, all of them are securing direct mining deals. Why? Because they don't trust Comex to deliver. When the biggest technology companies and defense contractors on the planet start bypassing exchanges and going straight to mines, that tells you they've lost confidence in the system. And here's why that matters for March. Industrial users of silver cannot afford production stoppages. If they run out of silver, their production lines stop. And when production lines stop, they lose millions of dollars per day. So what are they doing? They're hoarding. Just-in-time inventory management? Gone. They're building 6 months of inventory instead of 3. And every ounce they hoard is 1 less ounce available for delivery at Comex. Now let's talk about what a delivery failure actually means, because this is where most people don't understand the implications. If Comex cannot deliver 80 million ounces in March, they have 3 options. Option 1, deliver what they can and force the rest to settle in cash. That's called force majeure. It's when the exchange declares it cannot fulfill its obligations due to circumstances beyond its control. If that happens, the paper market loses all credibility. Because the entire point of a futures contract is that it can be converted into physical delivery. If that conversion breaks, the contract is worthless. And anyone holding paper silver, ETFs, unallocated accounts, futures, realizes they don't own metal. They own a promise. And that promise just got broken. Option 2, raise margin requirements so high that it becomes prohibitively expensive to hold contracts into delivery. This forces traders to close positions before notice day. We've already seen this playbook. On February 2nd, CME announced margin increases. They can do it again. They can keep raising margins until only the most capitalized buyers can afford to stay in. But that doesn't solve the underlying problem. It just delays it. Because the industrial buyers who need the metal will still need it in April, May, and June. So you're just pushing the squeeze forward. Option 3, the price goes parabolic. If Comex can't force cash settlements and can't shake out all the buyers through margin increases, the only way to clear the market is through price. Sellers who have the metal will demand higher and higher prices until demand drops or new supply enters. And in a squeeze, that process can happen very quickly. Silver could go from 90 to 150 in a matter of days. We've seen it before. In 1980, during the Hunt Brothers squeeze, silver went from $6 to $50 in a few months. In 2011, silver went from 18 to 49 in less than a year. Parabolic moves are possible, and March could be the trigger. Now let me connect all of this, because when you see the full picture, it becomes undeniable. 5 consecutive years of supply deficit, 820 million ounces short. That's nearly an entire year of global mine production consumed and never replaced. And that number doesn't include military consumption. Because in 1996, 5 United States government agencies, including the Department of Defense, stopped reporting how much silver the military uses. 30 years of silence. The Silver Institute does not include military applications in its supply and demand reports. Not missiles, not satellites, not radar, not guidance systems. None of it. The most detailed silver accounting on the planet has a hole in it the size of the entire United States military. The 820 million ounce deficit I showed you, that doesn't include a single ounce consumed by the largest military on Earth. And the government that classified the data is the same government that just designated silver as critical to national security. They know the real number, they're not sharing it. So the actual deficit could be dramatically larger. 1.2 billion ounces? 1.5 billion? We don't know, but we know it's worse than reported. Now add everything else. China controls 60 to 70% of refined supply and locked the door 5 weeks ago. Physical trading at 80% premiums over paper. Lease rates hitting 200%. 33.45 million ounces withdrawn in 7 days. JP Morgan flipping from short to long and controlling 40% of futures and 50% of deliverable inventory. Samsung bypassing Comex and locking up mines directly. Industrial buyers hoarding instead of just-in-time ordering. And 40 million ounces standing for delivery in January when it's supposed to be 1 million. Every single data point points in the same direction. March is not just another delivery month, it's the stress test. And based on everything I've shown you, I don't think Comex passes. Bill Holter said it. There will be failure to deliver silver in the first part of March 2026. The currencies will zero out. It's a collapse of the entire financial system. I'm not saying I agree with the entire financial system collapsing. That's an extreme scenario. But a Comex delivery default? That's not extreme. That's math. If 80 million ounces stand for delivery and Comex only has 50 to 70 million actually available, they can't deliver. Period. And when they can't deliver, one of three things happens: force majeure, parabolic prices, or both. So what should you do? If you're holding paper silver, SLV, unallocated accounts, futures contracts, you need to ask yourself a hard question. Do you trust the system to deliver? Because the refineries just told you they can't. The vaults are telling you they're empty. The industrial buyers are telling you they don't trust exchanges. And JP Morgan is telling you by flipping from short to long and hoarding every ounce they can get. If you're thinking about physical silver, now is the time. Not because I'm telling you to, because the data is telling you to. When the largest companies on earth are bypassing exchanges to lock up mine supply, that's a signal. When lease rates hit 200%, that's a signal. When January sees 40 million ounces of delivery in a non-delivery month, that's a signal. March is 4 weeks away. And the math doesn't work. Do your own due diligence. Understand the risks. This is not financial advice, but the data is the data. And the data says Comex might not be able to deliver. Drop a comment. What do you think happens in March? Does Comex deliver? Do they default? Or do prices spike to clear the market? I read every single comment. This is Mark from GoFinance. The silver reset isn't coming. It's here. Stay sharp.